Good evening, everybody. Ron Wheeler here, and it's my pleasure to bring you tonight's special presentation, The Anatomy of a Credit Spread. So, over the last 9 years, you've seen me talk about things like the options paycheck. You've seen me talk about probability. You've seen me talk about being an option seller. What I want to do in tonight's presentation is talk about the mechanics, why we do credit spreads, how you make money with a credit spread, what are the advantages of a credit spread. I want to dig into the details so that even if you've never traded an option before, you're comfortable with the process, you know what it looks like, and most importantly, you kind of get the idea of the nuts and bolts of what goes on behind the scenes. So the first thing I want to dive into is, why do I do this? Why do I use credit spreads? Why am I an option seller, first off? Well, I want to start all the way back at the beginning, back in 1997 when I first started trading. I was primarily a day trader. I traded commodity futures, the S&P, crude oil, bonds, corn, wheat, you name it. One of the things about being a trader and investor, as most of you know, it really revolves around two things. Number one, you have to find direction. If you want to buy something, or if you're planning on buying something, whatever it is, whether it's a stock, whether it's a ETF or a future like I was doing, if you bought something, it has to go up for you to make money. If it goes sideways, you lose. If it goes down, you lose. And then vice versa. As an investor, if you short sell something, it's got to go down. If it doesn't, you're simply going to lose money. Now, once you get past the hurdle of understanding direction, then you have to bring into the element of risk management. Well, it's no good if you're really good at picking direction, but when you have 7 winning trades and you make $10,000, but on 3 losers you lose $15,000, what good is being 70% right? The beauty of being an option seller is controlled risk. Controlled risk and the ability to add probability. You know, at VectorVest, we pride ourselves on picking good stocks rising in price when the market's going up, and then vice versa when the market's going down. We have a good feel about direction. Now, let's take that direction and let's add some probability behind it as well with how we set those trades up. So it really all comes down to probability and risk control. These are the reasons why I am an option seller. And I will say 99% of the options trades that I do a year involve selling an option because they give me probability. They give me the ability to control my risk. I know what the max risk is at the very beginning of the trade, and this allows me to protect myself against any catastrophic loss. So the first thing I want to do is I want to talk a little bit more about probability because that's the primary reason that we're doing this. So in a market, right, as a stock moves up, and I'm going to focus on bullish movements today in this presentation because we don't have the time to talk about everything, so I'm just going to talk about bullish. But let's do this instead. I actually want to look at a graph of a current stock. So let's change over to a graph. And this is a graph of Walmart. So when I talk about probability, this is what I mean. If I went out there and I think that Walmart's going to continue to go up, and honestly, why would you not, really? If I look at the entire graph over the last, pretty much year, it's been a very bullish stock. But let's talk about right now. I'm going to zoom in a little bit here and kind of compress this down so we can see it. So let's say I go out there and I want to buy Walmart. Well, right now the stock's trading at 71.18. If I went out there right here and I just bought 100 shares, here's what's going to happen. If the stock goes up, I make money. If the stock goes sideways, I break even, but of course I would lose commission. And at some point, if the stock goes down, I'm going to lose money right off the bat. But eventually, I'm going to hit a stopping price and I'm going to exit the trade. We're not going to just keep Walmart forever, right? We're going to have a stop in place at some point. So the only way I make money if I trade Walmart is if the stock goes up. Now let's add the element of options. And let's start with the first one here. Let's see buying an option. Because that's the primary trade that most option traders do, right? They buy options. They buy a call. When you think a stock is going to go up, you buy a call. So what I want to do next, I'm going to bring in a tool that we have in our Options Pro software. It's called the projection tool. So let's click on projection and I'm going to open this up a little bit. Now I'm going to move some screens around because some of them really aren't all that important for what my presentation is here today. All right, so a couple things. Number one, I want you to focus on this projected underlying. And I'm going to remove some things that, for right now, I don't really think are important. This graph right here that I'm looking at. This is a picture of Walmart. This is the graph of Walmart based on today's price. And then you see a blue line moving out to the right. So what I'm looking at now is I'm looking at an August 16th $70 call. You're basically buying a slightly in the money call that expires in about a month. Okay. Now, it doesn't matter when the option expires. You can look at this and say, well, Ron, I would never buy an option that soon. I would buy an option maybe out to September. Well, you know what? It doesn't really make a difference whether you buy in August, whether you buy a September. Ron, I would never buy an option with that delta. I'd buy something deeper, an 80. It doesn't make a difference what you buy. Here's what I want you to see. If over the next however long, this is where the current price of Walmart right here, this is expiration. Okay? Now, this yellow line is your break-even line. So essentially, if that blue line, which represents price, that solid blue line, stays below the yellow line, you are not going to make money. So now, if you go up here and take a look, here's Walmart, the current day. If Walmart does not move in price and stay sideways, you can see that by buying an option, by the end of expiration, you're actually going to lose money. This option is going to go from about a $310 premium down, and it's going to lose $192. At expiration, it's only going to be worth $1. Okay? As an option buyer, you're actually putting yourself, really, for lack of better words, behind the 8 ball. Because if the stock goes sideways, not only are you going to lose commission, you're also going to lose option value. The only way you make money as an option buyer is the stock has to not only go up, but it has to go up a certain amount. So let's say the stock goes up a couple of bucks. All right, great. It went from $71 to $73. You're still not making money. Well, you really have to have this stock move up tremendously for you to make money on this trade. You got to stay above that break-even line. So when you're an option buyer, you actually have to have the stock not only move up, it has to go up even farther. It has to overcome the premium value for you to make any significant money. Now, the good thing about being an option buyer is you still do get that risk control. Walmart can go down to $5 a share, and the most you're going to lose is the premium. So at least you get the risk control. But what you don't get is the probability. And that's why I am not an option buyer. So now that we kind of outlaid why buying options may not be the best thing, let's talk about why selling options really helps and how it adds probability. So let's go back to that Walmart graph. So here's Walmart. So what I want to do as an option seller is I want to pick a place that I don't think Walmart's going to go to. Now, I'm hoping that Walmart continues to go up. But let's now pick a price where we say, I don't think Walmart is going to go below. So I look at this graph and I can just look and say, well, how about $70? So over the next 21 to 45 days, this is how I choose my options expirations. I do not think that Walmart is going to go below 70. I think the stock is going to go up, but I'm comfortable giving it room down to about $70 to see if it can stay above that and I can make money. Now, that's an interesting point, right? $70. Well, Ron, why did you pick 70? Why didn't you choose 65? Why didn't you choose 61, 69, 73? Why did you choose that particular price? It's all about probability, right? How is probability defined? Well, what probability is done and what probability is, we look back at what the stock has done in the past. This is called historic volatility. The historic volatility will give us an estimation, a percentage estimation of will that stock be above or below that price by options expiration. So let me show you this. I'm going to open up an option chain and we're going to go to Walmart. I'm going to choose an option that expires within 21 to 45 days. In this case, I'm using the August 16th expiration. Now, in a bullish market, I'm going to sell a put, and I'll explain why here in just a few seconds. So if I look at a $65 put, and I move my cursor over to the right, there is an ITM percentage. That's the chance that that option will go in the money. So what that probability is saying is this. There is a 6.5% chance that Walmart will be below $65 in the next 28 days by expiration. That's a very simple way of explaining it. If I take a look at the $70, there is a 39% chance that Walmart will be below $70 a share by expiration. So if it's got a 39% chance of being below it, there is a 61% chance of being above it. So if I perform this transaction at $70, I have a theoretical percentage of probability that's 61% correct. So let's go back to that graph. So at $70, there is a theoretical 61% chance I'm above that by expiration. And I don't have to wait for expiration. I'm going to be in and out of this trade typically in about 7 to 10 days. So I have, and I'll just kind of write it on the graph here, I have essentially a 61% chance of being here, and I have a 39% chance of being here. Now, I want to show you what this looks like from the portion of an option trade. So I'm going to go back to that projection tool. Now, what I'm going to do differently this time is this. Instead of buying that call, I am going to now sell that August 16th $70 put. Now, watch the difference. If the stock goes completely sideways, look what happens up here. I'm profitable. I sold that option for $1.50 or $150, and if it stays above $75 or $70, pardon me, by expiration, I win. If the stock goes down, I still win. As long as the stock stays above that $70 price, I'm still going to win and make all the money. And in fact, even if it goes down a little bit farther at the break even, as long as it stays above $68.60 some cents, I can still make money on this trade. So now, if the stock goes up, I win. If it goes sideways, I win. And if it goes down, I still have the chance to have that winning trade. That's what that green represents in my profit and loss area. So I think we can all agree that that looks good, right? We now have probability. But now we've got to talk more again about risk control. And I'm going to introduce one more thing to you. This is called a risk graph. Now, if you're a new options trader, don't be intimidated by this. These are things that you'll learn as you go. But let's talk about a risk graph. What a risk graph does is it allows you to see what the profits and losses will be on your option trade, kind of like that projection tool, but a little bit different. It's going to show you what your profits and losses will be on your option. So for instance, if I went out and bought a $70 call, and very simply, if the stock moves up to, let's say, $74 a share, I can look at this risk graph and I can see what my profits will be. Now, when you buy an option or you sell an option, it's not like when you buy or sell a stock, right? When it's, if the stock moves $1, you make $1. Options are a little bit different. You've got things like Delta and Gamma and Vega. Those really aren't all that important to this. Yes, they're important in how they move the options premium, but you don't need to know the details of those to be a successful option trader. It's not that vital. So here's a risk graph. Now what I'm going to do again is I'm going to set this trade up as a sell. I'm going to sell one August 16th, and we're going to choose a $70 put, and I'll click OK. Now, as you can see, number one, that trade has a 39% chance, okay, of making money. However, I want you to look over here to the right. This is your risk control. The most that I can make on this trade is $150. I can lose $6,850. That right there is the opposite of risk control. Now, if you've never sold an option before, let me explain how this works. When you sell an option, you are selling it, but it's not like when you sell a car or something, right? You sign over the title, you give the car away, and your risk is done. Your responsibility for that asset's gone. When you sell an option, that what you are selling is your promise. You are telling the market that, hey, I am willing to buy this stock at $70 a share if I need to. If I am called upon to do it, I will buy the stock at $70. Now, before you get all worked up over that, understand one thing. I've been doing this now primarily for 15 years. It's never happened to me in one of these types of credit spreads that I do in the options paycheck. I don't get assigned stock. It's never happened because we use a stop. We don't take and keep the trade until that's a possibility. But let's say that you sell this $70 put, all of a sudden something crazy happens, there's a scandal at Walmart and the stock opens up at $50 a share. Well, if the stock were to open up at $50 a share, that's right here on the risk graph, all the way back here, you're looking at a loss of $1,900. And what could be worse here is this. You now may be forced to buy the stock at $70. So you now own a $70 stock that's only trading at 50 bucks. That's not good risk control. So as an option seller, I have to add the element of risk control. So let's do that. So we already talked about that in a bullish market, we're going to use puts. We're going to sell a put. Now, going back to the concept of why we sell a put when we're bullish, let me show you one more thing. If I go back into that projection tool, I sell a put, a $70 put in this case. The stock can go up as much as it wants to, and it doesn't make a difference. I'm still going to make money. So when I sell the put and I think a stock's going to go up, my goal is for the stock to move away from $70. The farther and farther it moves away from $70, the better for me. The reason why we don't want to sell a call when we're bullish is this. Let's do this. Let's instead sell a $75 call on this stock. Well, now what happens is this. If the stock moves up too much, we could actually lose money. You don't want to do that. You don't want to have a stock and say, okay, I think Walmart's bullish. I want it to move up so bad, but only this much. Give that stock the freedom to run. Think about this. If you look at Walmart, if Walmart moves up to $75 over the next month, yeah, you can still make money at the end, but you're going to have to sit in that trade for a very, very, very long time at a loss. And if it moves up too much, you're actually going to lose. So the idea here is we want the stock to move away from the option we sell. So again, by going to that $75 or $70 put, you can see that it doesn't matter how much the stock moves up, I still make money. That's why in a bullish market, we sell puts underneath the price of the stock. So again, bullish trade, we're going to sell puts. However, as we talked about, when you sell a put, it has unlimited risk. Essentially unlimited risk. I mean, the stock can go to zero and the risk is over, but you essentially have unlimited risk here. So what we're going to do is we're going to perform a trade called a bull put spread. And what that is, it's the simultaneous selling of the put and the purchase of an insurance put. Okay? We call that option insurance because it protects you. It limits the amount you can lose and it makes it a low risk, controlled risk trade. Now you have a maximum loss that you can see. Okay? Why do we buy insurance? Well, again, it reduces your risk. It also reduces your trade cost. To sell an option, what's called naked, requires a lot of capital. And it also requires a high level of options experience as well, or a lot of capital, kind of a combination of both. So we do this to reduce your risk and reduce your trade costs. Let's go back real quick to that Walmart trade. Now I'm going to go back to my risk graph. Now, as you can see, if I sell that $70 put, over here on the right, I have a very, very big risk. But if I go in there and edit, and let's add some insurance. Now the insurance leg is always below the option you sell. So if I sold a 72, I'm going to have to go lower. How about a 67.50, and we're going to buy that option. Now what you've done is you've limited the profits on the trade to 80, and the most you can lose no matter what is $170. So you've limited that risk. Now this trade as it sits, I still would be a little skeptical of it. $80 in profits and $170 in risk, I don't know about that. This is only step one of risk control. This isn't the whole thing. This is how we can at least maximize our loss. So if something happened tomorrow where Walmart sold off and it opened up at $50 a share, and let's say you had to buy the stock at 70, well, when you buy a put at 67.50, this allows you to now exercise that right, and you can go sell the stock to somebody else for 67.50. That's going to limit your risk to $170. Now that's still not good. That's still not good. Think of this in terms of just money, right? I'm telling you this trade has a 60% probability of success. All right? 60% probability of success. So let's do some quick math. If I make money, let's say I take this trade 10 times. If I make $80 6 times, I'm going to make $480. But what happens if I lose 170 4 times? I'm going to lose 680. That's not good. That's why setting up the spread is only step one of risk control. We're going to talk a little bit more about how we continue to do risk control as we continue. So again, bullish trade, we're going to sell puts. However, as we talked about, when you sell a put, it has unlimited risk. Essentially unlimited risk. I mean, the stock can go to zero and the risk is over, but you essentially have unlimited risk here. So what we're going to do is we're going to perform a trade called a bull put spread. And what that is, it's the simultaneous selling of the put and the purchase of an insurance put. Okay? We call that option insurance because it protects you. It limits the amount you can lose and it makes it a low risk, controlled risk trade. Now you have a maximum loss that you can see. Okay? Why do we buy insurance? Well, again, it reduces your risk. It also reduces your trade cost. To sell an option, what's called naked, requires a lot of capital. And it also requires a high level of options experience as well, or a lot of capital, kind of a combination of both. So we do this to reduce your risk and reduce your trade costs. Let's go back real quick to that Walmart trade. Now I'm going to go back to my risk graph. Now, as you can see, if I sell that $70 put, over here on the right, I have a very, very big risk. But if I go in there and edit, and let's add some insurance. Now, the insurance leg is always below the option you sell. So if I sold a 72, I'm going to have to go lower. How about a 67.50, and we're going to buy that option. Now what you've done is you've limited the profits on the trade to 80, and the most you can lose no matter what is $170. So you've limited that risk. Now, this trade as it sits, I still would be a little skeptical of it. $80 in profits and $170 in risk, I don't know about that. This is only step one of risk control. This isn't the whole thing. This is how we can at least maximize our loss. So if something happened tomorrow where Walmart sold off and it opened up at $50 a share, and let's say you had to buy the stock at 70, well, when you buy a put at 67.50, this allows you to now exercise that right, and you can go sell the stock to somebody else for 67.50. That's going to limit your risk to $170. Now that's still not good. That's still not good. Think of this in terms of just money, right? I'm telling you this trade has a 60% probability of success. All right? 60% probability of success. So let's do some quick math. If I make money, let's say I take this trade 10 times. If I make $80 6 times, I'm going to make $480. But what happens if I lose 170 4 times? I'm going to lose 680. That's not good. That's why setting up the spread is only step one of risk control. We're going to talk a little bit more about how we continue to do risk control as we continue. So again, bullish trade, we're going to sell puts. However, as we talked about, when you sell a put, it has unlimited risk. Essentially unlimited risk. I mean, the stock can go to zero and the risk is over, but you essentially have unlimited risk here. So what we're going to do is we're going to perform a trade called a bull put spread. And what that is, it's the simultaneous selling of the put and the purchase of an insurance put. Okay? We call that option insurance because it protects you. It limits the amount you can lose and it makes it a low risk, controlled risk trade. Now you have a maximum loss that you can see. Okay? Why do we buy insurance? Well, again, it reduces your risk. It also reduces your trade cost. To sell an option, what's called naked, requires a lot of capital. And it also requires a high level of options experience as well, or a lot of capital, kind of a combination of both. So we do this to reduce your risk and reduce your trade costs. Let's go back real quick to that Walmart trade. Now I'm going to go back to my risk graph. Now, as you can see, if I sell that $70 put, over here on the right, I have a very, very big risk. But if I go in there and edit, and let's add some insurance. Now, the insurance leg is always below the option you sell. So if I sold a 72, I'm going to have to go lower. How about a 67.50, and we're going to buy that option. Now what you've done is you've limited the profits on the trade to 80, and the most you can lose no matter what is $170. So you've limited that risk. Now, this trade as it sits, I still would be a little skeptical of it. $80 in profits and $170 in risk, I don't know about that. This is only step one of risk control. This isn't the whole thing. This is how we can at least maximize our loss. So if something happened tomorrow where Walmart sold off and it opened up at $50 a share, and let's say you had to buy the stock at 70, well, when you buy a put at 67.50, this allows you to now exercise that right, and you can go sell the stock to somebody else for 67.50. That's going to limit your risk to $170. Now, that's still not good. That's still not good. Think of this in terms of just money, right? I'm telling you this trade has a 60% probability of success, all right? 60% probability of success. So let's do some quick math. If I make money, let's say I take this trade 10 times. If I make $80 6 times, I'm going to make $480. But what happens if I lose 170 4 times? I'm going to lose 680. That's not good. That's why setting up the spread is only step one of risk control. We're going to talk a little bit more about how we continue to do risk control as we continue. All right, so let's flip the script a little bit. We kind of have an understanding of how it works when we have a winning trade. Let's talk about a losing trade. So again, the first part of the trade is we're selling a put and receiving $350. We're buying a put and we're paying $100. So when we enter the trade, the net result of that is collecting $250. So instead of the stock going up, what happens if the stock moves down? Well, remember, the original price of the trade is we sold the option and collected $350, and we bought the option and paid $100. Now, as the stock moves down, the price of the option we sold is going to increase. So it was trading for $350, now it's trading for $700. That's not a good thing as an option seller. The option that we bought was trading for $100, now it's trading for $200. So how does this work? Well, when we entered the trade, we collected that $250. Now, if you look at the net of that trade, it's worth $500. So we're going to have to pay the broker $500 to exit this trade. So we lost the $250 that we collected, and then we have to dig into our trading account for another $250. So we lose $250 on this trade. Now, from this trade, you can see that, well, eventually we did exit the trade, right? We didn't let the trade expire. We don't do anything like that. When we enter the trade, we have a profit target. When we exit the trade, we have a pre-built stop. Now let's go back to that Walmart trade, and I'll kind of show you what that looks like. So if I was to do this Walmart trade and I sell a $70 put, I'm going to exit the trade if the stock were to drop below $70. That is going to be my predetermined stop. The price at which I sell the option, this is where I exit the trade. Now, if I exit the trade at that $70 price, which is about right here, I'm going to move my cursor as close as I can. If you look up in the upper left-hand corner, I'll just kind of point it out right here, then I'll move my cursor to that spot. You're going to see that my actual projected loss at that point is about $219. I have the maximum I can make on this trade of $800, and as long as I get out when the stock goes below 70, I lose $219. That is how we control risk. Now, I know a lot of you might say, well, Ron, what if the stock gaps? Last couple of days, right, we've had some pretty significant gaps. Okay, what if Walmart gapped down to $65? All right, well, you're going to take a bigger loss, obviously. You're going to lose about $1,100 in that instance, but you still have a very controlled risk. And gaps are not routine. Out of 100 trades I make a year, I probably have 3 or 4 gaps that I have to account for. It doesn't happen as often as you think it would. So this is a little bit about how option spread works, a little bit about the details of probability, how it's calculated, how we look for it, and then also the nuts and bolts of why we sell options instead of buying. So I hope that was a nice little introduction for you. Now, if you're serious, if you like what you see about being an option seller, now is the time to learn all about it. We are launching a new Options Paycheck Experience class that kicks off in August. It starts actually on July 30th is our first class, so registration will close before then. However, if you want to take the class, if you're interested, after going through that experience, you're going to learn exactly how calls and puts work. You're going to know all the fancy terms of options. That way you never have the fear of options again. We're going to give you clear signals telling you when to trade, when not to trade. You're going to be able to quickly identify the stocks that are the best candidates for this type of income trading. You're going to set up income trades that can give you that base level of 70% probability. We're going to teach you a trade management game plan to have in place before the trade is taken. That way you know what to do, whether the market goes for you, against you. You're never going to be frozen like a deer in the headlights again. You're going to be able to confidently enter and exit your trades with a broker like you're a pro, whether it's your first trade or your 500th. You're going to learn how to implement a system that can help you safely and generate consistent income. Now, the course itself is 8 modules. We're going to teach you the course through the month of August. And every week, we're going to meet together with you through the use of our mastery system. You're going to get the mastery package bonus. We're going to have 2 live mastery sessions classes a week in August. They're dedicated to help you learn and master the course material. You're going to watch the modules on your own, and then we're going to meet twice a week to discuss live the curriculum. If you can't view the live sessions, it's not a big deal. We record all of it, so you can view the curriculum all through recorded classes if you'd like. We also have a wrap-up weekly Q&A where we'll answer any remaining questions. You get a private dedicated email. If you don't have a subscription to VectorVest and Options Pro, we'll give you a subscription to that software for the 2 months of the live curriculum through August and the first parts of September. You're going to have the tools that you need and the support to learn how to do this properly. And then in September, we're going to open up our implementation month. You're going to be able to trade alongside me in my URS coaching group. Every Monday I do live trades. You'll be able to follow along. You're going to see me actually put this into practice. We also have 2 office hour sessions a week. We're going to basically be repeating the process to you over and over and over again. We are going to make you a good option seller. Even if you've never done this before, you can do it. We are going to teach this to you over the next 2 months. We also have my bread and butter SPX paycheck system. I've been doing this now for probably close to 15 years. There's 2 different strategies you can use. You can boil this down to a trade in as little as 15 minutes a week. one trade on one index symbol. It's got one setup rule, one profit rule, and again, there's some live trading sessions to teach you how to do this properly. And with all courses I do here at VectorVest, you have a 100% money back guarantee. You can go through the entire course. If you're not satisfied, all you got to do is let us know within a week of the course, and we can give you a refund. The only thing you got to do, though, is actually do it. Watch the recordings. Come visit us live. Just make sure that you actually commit to doing the program, because we know if you do, you will be successful. So if it's something you're interested, we're going to open up our special early bird pricing at $9.95. Take a look, go to optionspaycheck.com. You'll see a lot of different testimonials, some feedback from our former classmates. Sign up for it. It's $9.95. Get the year going. Get yourself a good income approach. Learn the concepts of selling options. It's a trade that every investor should have in their arsenal. Thanks for viewing tonight. I appreciate it, and have a great evening. Take care, everybody.
Yeah.